Hello and welcome to the Better Business Podcast. My name is Alexi, and today we've got our guest, Phil McGann from Claritude Financial Solutions. How are you, Phil?
Very well, Alexi. Very nice to see you. Thanks for inviting me on.
Thank you. Thanks for making the time to get on this podcast. Well, guys, obviously we had quite a multitude of various guests, and we touched on a various number of topics. For me, the whole idea, as always, is to interview interesting business owners who do things slightly different or know things, to a degree that most people don't, which actually makes them an expert. So Phil's an expert in financial planning, and he specializes in superannuation specifically, but there's obviously a lot more than he knows. And it's really a matter of, I guess, asking the right questions. So hopefully, I'll be able to do that today. So Phil, tell us about Claritude. Tell us about yourself. How did you get into this whole financial planning? I mean, it is one of those things that's a bit, borderline. Do you need a financial planner? Should you use one? What do you get them to do? I mean, tell us about your business and what financial planners do.
Basically, I set this business up a couple of years back now, probably about 2.5 years ago, Claritude Financial Planning. I've been a financial planner for, probably about 24 years now. So a long, long time. Worked at different sort of areas of financial planning. I have worked in stockbroking and finance broking and all the rest before that. So I've got a wealth of experience in the area. But what attracted me to financial planning initially and ongoing is the human contact, I suppose, the personal contact I have with my clients, and at a real personal level, that I can add value for them in what I know and what I can sort of look at their situation, look at it from a different angle and a different vantage point, and try to give them input and advice into that. It's an all-encompassing profession. We look at a lot of different things. Super's a main part of it, retirement planning in particular, but we look at all avenues of investing as well. This business has been set up primarily to look at pre-retirees and retirees. So I help people from, say, mid-50s to beyond, who are getting ready to retire, and helping them in that sort of phase of their life. I do a lot of work with younger people as well, but that's probably the main focus I'm looking on at the present time, and there's a lot in there.
Yeah, I do find quite a lot of young entrepreneurs do not think about their super too much, because they obviously want to get access to the funds straight away. However, once you sort of hit a certain revenue target, obviously having super is definitely a great way to put money aside. And by the way, I should mention that none of this podcast is a financial advice in any way. Phil is quite regulated as to what he can say, but hopefully he'll be able to provide us with some gems.
It's general information. It's not personal advice. I don't know the individual I'm seeing or looking at me on the screen. So you don't take anything to heart without having a chat to a financial planner, hopefully myself.
Yeah.
But look, as far as you sort of say there, Alexi, some of the business owners that are watching this and people you deal with in your marketing business, keep in mind that if you've got a successful business and you're generating a lot of free cash flow and looking to do something with it, think of your superannuation as I call it an off-farm asset. It's a bit like the farming community. If you have everything tied up in your own business, all the success in your total financial well-being is tied up with that business. If you have investments external to that, off-farm, so to speak, in superannuation in particular, that is a very tax-effective way to actually invest, and it's completely different to your business. So if something happens to your business, that there's some headway, not for your own reasons or problems, but the economy, at least you've got these other assets external to what you do day to day. So look at it from that point of view as a diversification tool.
Yeah. Well, before we jump into any strategies or any of that investing side of things, let's talk about the current economic campaign. I mean, for me as a business owner running a digital marketing agency, I'm finding that people are a little bit, they're somewhat delaying the process of pulling the trigger on their purchases and their decisions now. And it feels like it's obviously being affected by the whole economy slowdown. So what's the landscape at the moment? What's happening?
Well, I mean, what's happening at the present time is a real after a shock or after effect of the pandemic. We're still impacted by the pandemic from 2.5, 3 years ago. And basically what happened, obviously we all know the pandemic, and the whole world was shut down for legitimate health reasons. Lockdowns and emergency stimulus packages from central banks and from federal governments around the world to really wade off or fight off the risk or the potential of a depression. It's not a recession. They were very, very fearful that we were going to go back to the 1930s and there was going to be widespread devastation economically around the globe. That was averted. We had a short, sharp recession around the world, but we really came out of it. And the way they did that was they cut interest rates to zero, central banks did, and governments around the world threw money at the economy. Think JobKeeper in Australia. And a lot of your owners listening to this would potentially would have been benefited from that to keep their business going, to keep their employees engaged in the midst of lockdowns that have mandated on them by the authorities. But we're having the after effect of that now. What that introduced was lockdowns caused lots of supply chain problems. Think trying to buy a new vehicle 12 months ago, 18 months ago, and you had 12-month wait. We couldn't get vehicles into Australia. We couldn't get supply chains fulfilling what we're trying to do and trying to resell to our clients. And that is still ongoing to a certain extent. That caused lots of issues in the global economy and the local economy. Low interest rates meant there was really an issue of unlimited supply of cash. There was lots of cash floating around and lots of credit available. So there was a real pent-up demand. The ultimate result of that was high inflation, and we're feeling the effects of that now. So the economy has opened up again. There is still some people with a reasonable amount of cash looking to deploy those funds and consume, but high inflation has led to high interest rates, and we've had a rapid increase in interest rates over the last 12 months. And where we are right at the moment is, has inflation peaked? Potentially. Inflation has led to high interest rates, as I said, and we've probably got maybe one more rate rise in Australia to come, but we're seeing the after effect of that. We're basically seeing households in particular, who make up effectively about 60 to 70% of the consumption in Australia, are really struggling. Some people in some households are really struggling with high interest rates and high debt, and that's having an impact for your clients, Alexi, around the economy. People are, particularly in discretionary items, finding it pretty tight. And going forward over the next couple of quarters, it'll really start to bite in certain sectors. That's the issue. So that's where we are at the moment. We're feeling the effects of the changes to the economy from the pandemic and the result of the central banks and the federal governments around the world trying to rescue us from a depression, and we're feeling the aftershocks of that. And it will go on for another year or two. And trying to navigate that through businesses, it's pretty tough. And you talk to people every day, as I do, about how they're finding that.
Yeah, absolutely. Well, look, I guess, the economy is obviously quite a complex, quite a complex organism, if you like. It's got a lot of dependencies on other things as well. And I find personally that a lot of businesses have been disrupted with the whole import situation, where things have been delayed and not being brought in, to the country in time. And then there's been also shortage of certain things as well, like building supplies and so on, that are sort of impacting other things as well. So it is very complicated. I mean, for me, I guess I'm more curious about the interest rate at present. I mean, do you think that 6.5%, 7% interest rate for mortgages in particular is quite a healthy rate? Or do you think that's a bit, high compared to, what it should be historically? Because I find that a lot of people are complaining about the fact that, hey, interest rates are high, but really, like, what should an interest rate be? What's the average? And is there like a healthy or unhealthy sort of figure?
Correct. Yeah, I mean, this is the issue. You go back over the last 20 years, and the average home loan rate in Australia was probably hovering around 6 or 7%, maybe a bit higher, a bit lower over the last 20, 25 years, because we had inflation under control. It was a non-issue. Some of your listeners may well have grown up a long while ago, and back in the 70s, the high inflation was around, and it was terrible. High inflation is awful for an economy, because what it does, it basically distorts the purchasing power of individuals, and people get very anxious and sort of distorts how they deploy capital and make purchases and things like that. So high inflation has been around before, and what we've got at the moment is a fear that we will see high inflation entrenched in the economy. The Reserve Bank and locally in Australia has been putting interest rates up rapidly to curb inflation. They don't really... Their number one goal is to curb inflation. They don't want it entrenched in the economy, and the expectations into the future that inflation might be higher than it is today. So they haven't got there yet. People aren't thinking inflation is going to get running away, but if it ever does, it distorts everyone's purchasing intentions. So the Reserve Bank is definitely more interested in getting inflation under control than worrying about whether the economy has a hard landing. I don't think the Australian economy will hit a recession later this year, but the international economies are likely to. The US is likely to go into a mild recession at the back end of this year. All the factors look that way. But in Australia, we may well avoid that. But we are seeing some areas of the economy in recessionary times. Think building at the present time. There's lots of reasons why there's lots of building collapses going on and things like that. But that's a very area of the economy that's really stopped to a certain extent. So anyone in the building game has found it very expensive. Equipment, employees, trades, all those sorts of things is very difficult to get at a reasonable price. And that side of the economy has really ground to a bit of a halt, which is problematic because it's such a big part of the local Australian economy. But then other sectors are doing really well. Mining is still a fairly profitable enterprise because of impacts from overseas. We're in a globalised world, the war in Ukraine, energy prices high, and so that's led to very high prices for our commodities out of Australia, and that's led to a very profitable mining sector still. So you've got a bit of a two-speed economy. Some areas are really feeling the impact, and I would argue some of the discretionary spending for some of the firms out there. Your listeners likewise are probably involved in areas like hospitality and the like. That is a real issue because that's a discretionary item for most people, and they will find it tougher as they go on, as they already are over the last 3 or 4 months, as their customers are finding it very difficult with high interest rates. Their discretionary spending shrinks down considerably. That's where we're at the present time. So it distorts. High inflation leads to higher interest rates, which distorts the way capital is deployed around the economy.
Yeah, you've also got a bit of an evolution in the hospitality industry, specifically because a lot of the holiday are now facilitated through Airbnb, and they are a little bit direct, whereas before it was mainly the hotels. And if you look at the whole, price positioning of Airbnb versus the hotels, obviously the hotels are charging an astronomical amounts these days. And despite that, the pandemic, I think, has activated the holiday market per se in Australia. But with all the lockdowns over around the world, I think it's now starting to escape as well. But in essence, the whole measures that the government is taking is really just trying to slow down the spending of the Australian population. Is that really what it comes down to?
That's basically what's going on. I mean, you've got fiscal policy and monetary policy. The monetary side of things is the Reserve Bank is raising interest rates to cool the economy. They're independent of the government. The government will bring its budget down in the next 4 to 6 weeks. And what they're trying to do there is they don't want to add to the inflationary issues. They don't want to just splash cash out to actually try and help people they don't want to help people. They don't want to sort of add to the issue. If you give too much money out and tax breaks and things of that nature, you basically push more money into the economy at the same time the Reserve Bank is trying to cool the economy. And all that does is the Reserve Bank's got one remit: keep inflation low. They'll put interest rates up because that's the only tool they've got. So there's a real loggerhead there between the government and the Reserve Bank, and we'll know more about that in the next 6 weeks. But they're also playing in a globalised world. We import a lot of inflation into Australia, and a big one was the lockdowns, which we did to ourselves, legitimately. The government closed the borders and no immigration came in for probably about 18 months, and a lot of goods were restricted in what could come in. And likewise, the government, we've got impacts from high energy prices. Petrol's expensive, diesel's expensive. Not because of anything we've done here, but mostly because of the energy crisis caused by the Ukraine war over the last 12 months. So those issues are that's imported from overseas, but we're in a globalised world. We're not an island, so to speak, by ourselves. We need to actually interact. And but you can't curb inflation caused by high energy prices that come from offshore by putting interest rates up locally to a certain extent. Yeah. But the only tool they have is to put interest rates up to cool demand in the local economy. It's a moving feast, and that's the issue that the Reserve Bank and the federal government is dealing with day in, day out.
Yeah. Okay. Well, look, obviously this is a huge topic, and we could probably dedicate the entire podcast to it, but I'd like to pick your brain about a few other things as well. So let's talk about strategies in terms of financial planning in this current economic climate, if you like. So, from your point of view in terms of investing, and obviously there's a lot that's going on right now, there's many different options. What do you find that what sort of works best in terms of diversifying and lowering, I guess, the risk while trying to invest in a smart way with all this uncertainty?
Correct. Yeah, look, this is a big issue. I mean, the thing that all this is going on around us, right? So we're all individual investors. We make individual investment decisions, what we're going to invest in going forward, whether that's inside super or outside super. The interesting thing is we've got a high interest rate environment. Now, for a lot of people out there listening, they think straight away, and the media builds this up all the time, high interest rates are terrible for home buyers because people are borrowing a lot of money, particularly in the capital cities, to get into their first home or second home or whatever it may be. But on the reverse side of that, retirees, I deal a lot in that space, people who are at the other end of life and they're actually reducing capital or got a nest egg to reduce income from to live whilst they finish their working life. Low interest rates might be good for home borrowers, but they were awful for retirees because they got no return on their money, on their fixed interest portion of their portfolios. So high interest rates now are no good for home borrowers, but gee, they're pretty attractive for retirees because instead of getting zero return, literally you're getting no return on your money sitting in a bank account, you can get 4.5% now, which is a lot more attractive than zero, obviously. You can't have everything in certain growth assets. You need to have defensive assets as well. But I'd argue probably about 18 months ago, the only place you could really go, and it was an acronym of TINA, there is no alternative, you had to go into the share market to get a decent return because you had money sitting in the bank earning nothing. So a lot of people went further up the risk profile to actually invest in the equities market to get dividend return, to get income from their investments. Otherwise, they just weren't getting any return at all. Now, that's reversed to a certain extent because the share market has been very volatile, but you can actually get a return on fixed interest now. So people have got to keep that in mind, and that's inside or outside of super. If we're looking at super, you can invest across asset classes. So you can basically invest in growth assets or defensive assets. Growth assets are the local share market, the international share market, property infrastructure, broadly speaking, and defensive asset classes are fixed interest, cash, credit. And that's basically income from those investments. So one gives you capital growth and income, and the other gives you mostly income return. So you've got to have a bit of both. You can't have everything in one or the other. And you've got to balance it around. And the other issue that people tend to have as well is the fact that the return you're getting from your fixed interest portfolio is not a real return. And what I mean by that is, yes, you can get 4.5% in the bank. And I had a client say this other day, Phil, I did really good. I've got a fantastic return, 4.5%. Inflation is running at closer to 7%. So he's guaranteed to lose 2.5% purchasing value of his cash over the next 12 months. He's got no chance of capital growth in that portfolio because he's got it all in cash. He's getting a return that he can see, but the real return after inflation is a negative return. So, that's complicating things as well. So to look at the scenario, the best thing listeners can consider is look at your allocation. How are you invested inside or outside super? Look at your interest rate, whether it's money on what are you paying on your mortgages, but also what return are you getting on your cash if you've got fixed interest investments there, and how that's sort of working through. So diversification for me, always key. You've got to make sure that the allocation is correct for your risk profile and your time frame and what you're trying to achieve, long-term growth or income now, but get that allocation right. And that's you're a fair way down the track to success.
Okay. And that's something that you do for people, right? So you look after their super and you help them sort of make decisions based around that?
Yeah, and that's very much so. So I'm looking at superannuation, the right sort of investment mix, whatever the allocation is very important, but whatever the structure they've got as well, whether it's self-managed super or whether it's an industry fund or a retail fund or whatever, we are forced to invest in superannuation. It's government mandated. You have to actually have superannuation if you're an employee. Whether you work for yourself and you are an employee of your business and you pay yourself that way, you've still got to put superannuation away somewhere. So you should make sure that your money is invested appropriately. Keep in mind that superannuation for the bulk of the population, it'll be their second biggest asset when they get to retirement. Their home will be worth probably more, and their superannuation will be a close second. But maybe for younger people these days who may not get into the property market or may not have a desire to, their superannuation is likely to be their biggest asset when they get to retirement in decades' time. Take control of it. Make sure that you get good advice on it. And as allocate, don't set and forget and say, well, I I can't do anything about it, and I can't access it for 20 years or 30 years. No, it's your money. make sure you're invested appropriately.
Yeah.
Because if you had that money in your own hand, you would know where it's invested. But because it's in super, it's still your money. You can't access it now, but you can invest it correctly.
Yeah. Well, I know you and I spoke in the past, and this is more about the strategy overall. And you're sort of mentioning that the safest and probably the best way to invest money into something long-term is using the law of averages, when you continuously sort of, buy shares or whatever it is that you're into over a period of time. And this way you avoid whether it's dropping or rising. You always sort of buy in that sort of weight, like in that sort of mid price. I mean, is that the sort of same thing for superannuation as a strategy? Would you sort of try to capture that?
Well, it is. Consider that what you're talking about there is dollar cost averaging is the terminology. And basically you start with a nominal amount, 5,000, 10,000, whatever it may be, and you're putting a regular amount in each month, $1,000 a month, say, and that's going in. So as the asset class you're buying, whether it's shares or property, whatever it may be, that's unitized, you're buying regular amounts every month and the price is going up and down, but you're getting an average price over the longer term. Your super is exactly set up that way, because you are mandated as an employee or as an owner of a business, and you're an employee yourself, you're putting money in regularly, and the government is going to make sure that soon that you have to get paid each month, not every quarter. They're working on that. But that's dollar cost averaging on steroids in a way, because you have to put the money in. The funds are going into investments over time. So it is government mandated dollar cost averaging. Let's call it that, because that's how it sort of works through. But you've got to keep in mind that you're investing whatever the time frame is, 10 years, 20 years, 25, longer. And if you're doing that methodically and money's going in, as of July, it's 11% of your gross salary is going in or has to be paid by your employer into superannuation. That's a lot of money when you work it through on the average income in Australia. So those funds should be invested appropriately according to your risk profile and the time frame and what you're there doing, but in the appropriate structure that is not too high on fees and things like that. They're all the things I do for clients, and I look at in the marketplace all the time to keep abreast of what's available to give my clients the right result. At the other end of the scale, that's what investing now, but retirees are taking money out of super. So they're basically producing an income. So it's a bit different again, but it's almost in reverse. You're pulling funds out of super on a regular basis to provide an income. So you've got to have an asset base there, build it up over time, and then you start deaccumulating. You're actually withdrawing funds out, but not so quickly that you run out of capital. So there's a science to it.
And obviously for the retirees, you've got to consider the age pension and other factors as well, investments and whatnot, in order to make sure... Yeah, in order to make sure they have enough income to sustain their lifestyle. So that's the sort of stuff that you look after. Okay, great.
That's correct. That's what I do. Yeah, that's a big part. I still do all the wealth creation, so to speak, at the younger end, but at the retiree end, I sort of handle both of those. So it's and they're both two sides of the one coin.
Yeah, I guess personally, I should probably add about the superannuation side of things, is that it's very important to understand to those specifically business owners who are maybe ditching themselves paying superannuation, thinking elsewhere. Superannuation actually has got, your insurances coming along with it. And, that's something that I personally would advise someone to review, because you got your life insurance, you got your income protection, and then you've got the TPD, terminal disability.
Total permanent disablement. Yeah. I mean, a lot of super at the certain level at industry funds or big retail funds, you can house your insurance cover inside your super fund at a policy level. So everyone in the fund is covered. So it potentially can be a lot cheaper. Income protection can be a bit more nuanced. You really need input on that, whether you should have it inside or outside of super. But point taken that it potentially could be a lot cheaper inside your superannuation. But any of you business owners listening, don't dismiss super as something, I can't access it for many years, so I'm not going to bother, and I'm just going to concentrate on my business. If you have to pay yourself as an employee, the way you're structured, and you have to put superannuation aside, make sure it's invested correctly and make sure you're not getting ripped off by high fees, and it's not sitting in cash or anything like that. You need to actually have the right sort of allocation.
Yeah, I guess that's what I wanted to allude to. Yeah, I guess just making minimal payments, and you obviously need to figure out exactly what that is, to your super activates those insurances, because I've actually had a case where someone hasn't been making contributions to their super, and the whole insurance side of things has been disabled as a result. So I found that, first of all, try to understand the fees, and I guess somebody like yourself should definitely be able to help people with it. But I found personally that in my case, being a business owner, the income protection side of things was the most expensive component of my fees. Specifically, and I decided to take my insurances elsewhere outside of my superannuation in order to balance that out, and that actually saved me quite a lot of money. At the same time, just to go back to that point on the actual insurances being active within your account. Sadly, I had a friend who passed away in 2020, and as a result of being self-employed, he hasn't paid himself salary, I think, for over a year. And after that, the whole insurance has been dismissed. And upon chasing up some of his employees and other people, they've been able to make a contribution, which actually re-enabled the whole thing as well. Now, I don't know if this is a common thing or not, but I found that, and I would advise everyone from my personal experience to make sure that those insurances are in place, they are active, and you know what actually is required in order to keep them active. Do you come across a lot of stuff like that?
Yeah, I do. Look, that comes up often. Now, what you're talking about there is a lot of superannuation funds used to have, or still have to a certain extent, default insurance. What they were finding was some people had multiple insurance policies or multiple super policies because they had multiple jobs, and they had lots of little insurances in there. And the insurance premiums were chewing away the capital because they weren't putting money in. The government brought in a couple of years back now, if you don't make active contributions into a super fund, off the top of my head, I think it's 16 months. If you haven't done it for 16 months, and that could be the case, self-employed, and you haven't put any money in, the cash flow's not there or whatever, those insurances can be disabled, so to speak. They can basically cease. And that's not good, because you think you've got the cover and you don't. And it could be as easy as making an election with your super fund to say, look, I haven't put any money in, or I'll put a nominal amount in, or just to let you know, I still want that insurance coverage in place. But it comes from having an advisor, someone who can look after those things for you, and I'll highlight that to you and say, the cash flow is not there at the moment, but why don't we sort of elect to maintain those insurances for these reasons? Or could we do it cheaper outside of super? Or what's the policy that you have? Like in your case, Alexi, the income protection is a more nuanced policy outside of super, may be better for some individuals, but that's a case if you need input and advice on those areas.
Yeah. Well,
it's pretty specialised, yeah.
Yeah, super is obviously a huge topic, and Phil's the expert in that. And I'm sure if you got lots of other questions, we can certainly make sure that Phil be available to address them. I think individually, because everyone's situation certainly varies.
Very much so.
I would obviously love to talk about a lot of other things, but with my podcast, I'd love to keep things short. A couple of things that I would love to pick your brain, and maybe in the future would be, investing in property for a business, crypto, and all the other stuff. And while I know you're somewhat regulated to talk about some of these markets, maybe it's a conversation for another day. So, yeah. So just moving forward, what are your predictions for the future of the economy? I mean, I don't know, you don't have a crystal ball, but I think out of what most people are knowing you for a few years, I think that your reading on what's happening is a lot more accurate than mine, because I'm a very intuitive person. And I do come across a lot of business owners who are very intuitive. Hey, this feels right. This is what's happening. This is what everybody else is doing. What do you think is coming up in terms of our economy?
Big, broad picture. Internationally, highly likely we'll have a recession in the US at the back end of this year, maybe potentially a mild recession, and then we'll see some recovery. Will we see interest rates come off in the States? The market seems to be thinking there might be rate cuts later in the year, but others are saying no. Locally, I think there'll be a slowdown. There is a slowdown occurring in Australia now. We'll probably avoid a recession unless inflation starts to kick up again and Reserve Bank keeps putting rates up and really causes the economy to have a hard landing. But it does appear we'll have a slowdown, but probably not a recession. But some areas of the economy are in recession-like environments at the present time. So it's pretty tough for some. So I understand that. Others are still doing reasonably well. What we'll see in the future is we'll probably have maybe one more rate rise, and then that'll probably be about it, unless inflation kicks up again. But keep in mind, when you're looking at the real economy and the investment markets, they work in a different time area. If you're investing in the share market now, you're really looking 12 to 18 months into the future. You're not looking what's going on in the economy now. You're investing in a company that to see what their cash flows and profits and dividends will be 12 months, 18 months hence. And that's why the share market tends to, when times are a bit dire on the front page of the news, the share market might be doing okay. And over the last couple of weeks, the share market's kicked up a little bit because of that very reason. Everyone seems to be looking through the doom and gloom now and saying inflation potentially has peaked locally. That means interest rates may well have peaked, maybe one more, and that's it. And then we'll see some better times into the future. That means profits will be better for companies in 2024. Reasonable time. That's what the market seems to be saying at the present time. But again, the best thing listeners can look at is make sure your allocation's right, be nimble, be vigilant about how your investments are performing, and get some good advice. That's the best thing you can do.
Excellent, excellent. And if anyone wants to approach you, what's the best way to sort of reach out to you?
Just reach out. All my details are there. You can go to my website, Claritude Financial Planning. You can contact me. You'll have all my details on this as well. Alexi, phone or email's fine, but just search up Claritude Financial Planning. I've got lots of good webinars and audio files and things like that on my website. You can see what I'm all about and how I sort of operate. Always good to have a chat. Happy to.
Yeah. Well, I'll make sure to put the details of Phil's business, in the comments of this podcast or a video, whichever way you're listening to us. I think it's definitely a good advice to speak to someone. I'm a big advocate of a concept of who, not how, being able to find people who are much better and more experienced than you in certain areas, mate. And I definitely consider you an expert in this whole thing. Now, let's take a step back from all this expert stuff and talk about your business for a little longer. And for those listening and thinking, hey, Phil's voice may be familiar. Phil's been speaking on ABC Radio for quite some time. And if you want to look him up, have a look for Philip McGann, ABC Radio. You'll find some of his podcast recording or episode recordings. I'm not sure exactly what they call him. He spoke on a number of different topics, the changes in the economy and whatnot. And I personally quite like that. So being on ABC Radio as a financial planner, that's quite a point of difference. Has that helped you in any way to increase your business exposure or get more customers? It
has. Look, it's been very good for me. It's given me another platform. It sort of allows me to sort of get out there in a broad reach to everyone. Being on ABC Radio is a very it's a privileged position. So I've been sort of very welcoming of that, and it gives you a lot of cachet in the economy, so to speak, in the profession. So I don't take that lightly. I take it very serious about what I talk about there and how I sort of approach things. And it just allows you that geographical reach is good. It was going all through Queensland. And also on different topics. So as soon as people hear you've been on ABC Radio, it improves your their sense of trust in what you are on about and your professionalism and the like. So it's been really good.
Credibility, 100%. And look, I guess I know quite a few financial planners, and I find that a lot of financial planners are very scared, probably the better word, to even do anything outside of the guidelines, because the guidelines are very tight. You guys are getting regulated a lot. There's a lot of policies in place. So what advice would you give to any financial planners that are, wanting to sort of step outside of that sort of standard way of marketing or position themselves and potentially get more customers?
Yeah, look, it's a hard one. I mean, it really is a case of putting yourself out, having lots of different networking opportunities and lots of different avenues to getting new clients on board. Don't be too wary. I mean, the regulations are there to protect the end client, and I definitely adhere to all of those, and I'm very serious about that. But by the same token, you qualify everything. I'm not talking today about individual circumstances. This is all general information that people are just listening to us talk about the economy and the like. But for any other financial planners out there, get out and about, meet lots of people, talk to different people. The media side of things is good. I've done a few webinars and things like that as well. Podcast sounds great. I haven't sort of had a try on that area, but I'll give that a go as well. But I think it's just a case of people like the fact that if you're accessible and you're not talking lots of jargon. I hope today I haven't sort of been laying it on a little bit. Anyone in any field, you tend to fall back to your comfort zone and lots of jargon, because I talk about this every day, but I try to keep it pretty straightforward and not be condescending to people, but to be accessible, to sort of say, well, this is where I'm at. This is what we think should be doing. This is how your situation is. Does that make sense? I'm always saying to clients, does that make sense to you? Can you tell me what I've just been talking about? And if they can repeat it back to you, that's great. They're bought into it. They're comfortable with it. As soon as you get people comfortable, they're open to opportunities, and that's why it's good for business. So I'd say, yeah, get out and about, talk to as many people as you can, find your niche, whatever that may be. I like talking on the radio and doing webinars and things like that. It may not be what you're there, but you may like doing public speaking or networking or whatever. But it's everything out there, trying your best to get out into the marketplace. A bit of a point of difference is always good.
Yeah. Well, I guess from my end, the way I look at it is, the whole business marketing is really about three things: know, like, and trust. So if people don't know you, then they can't like you or trust you. So get out, meet some people. And, I'm a big advocate of networking organizations like the Chamber of Commerce or BNI, for example, because there are many different opportunities to meet other business owners and work with them. The whole idea is not to sell to them, but to actually network and partner up with them. And I think, moving forward, it's very important to make sure that you got a strategy in place that you can actually work with. So, some people like to get phone calls and they can sell to those people on the phone, or at least, book appointments or whatnot. Other people need to go and meet other people to be endorsed by them in order to meet their customers. And sometimes it's really quite a big funnel that you're exercising in the end, where you need to see an X number of people in order to have a number of appointments, and then end up with a couple of clients at the end of that.
I think as well that you need to define where you want to operate. And this is any business, you can't do everything for everyone. You need to sort of narrow it right down and say, this is the area that I like dealing in and I'm good at and I'm professional at and I've had a lot of experience, and they're the sort of clients that you are looking for. You should be able to say that in a couple of sentences. And if not, you're too broad, and then the whole market doesn't know what you do. So you've got to narrow it down.
Yeah, absolutely. I think that being an expert in a particular field definitely sets you apart from a lot of other people, because people want to work with specialists as opposed to generalists. I mean, you may work with a generalist initially, but then when things become serious, you want someone who's absolutely the best and know exactly what they're doing. And that's exactly what business is about. Phil, I think we've covered a whole bunch of topics. It's probably going to be the longest podcast I've recorded so far, but I think it's been quite informative. There's been a lot of things that we touched on. Like I said, there's probably 50 other things I'd like to ask you, and maybe we'll see from our listeners if people want to get you back into this podcast. I try to generally talk about business and how business is developing, but I think financial planning, that's the blood of the business. And if you don't address the whole finance side of things, then you may as well just go home and watch Netflix.
That's true. No, thank you very much for having me on. It's been very enjoyable, and thanks everyone watching, and love to have a chat to people. Not a problem.
Yeah. Thanks very much, Phil. And look, guys, we've covered a lot of things: changes in the economy, what you can do with your super, what you should think about. Phil's got, a lot of different things that he could potentially answer. Make sure you reach out. If you're watching this, comment below, hit likes. I'd like to get some engagement from the videos. If you're enjoying my podcast, please subscribe, and you won't miss the next episode as well. Phil, thank you very much for your time, and mate, we'll chat soon.
Cheers. Thank you.
Thank you.